welcome to this evening. This is an ISTN event, but we actually host a series of different events across the month, all the way through from digital creative out to IoT. And the constant aim of this is twofold, really upskilling. So, and hopefully, and I know I've heard Luke talk before, I know we're going to learn some stuff tonight. So we really want you to get a bit more information. Probably the secondary goal within that part is to make sure you hear from Suffolk's best, of which Luke has had some significant roles in the area, is a gem in our midst. And the second element of it is to build a community. So I was just there's a couple of guys on here with a startup, and I was just saying, sometimes if you're a non-technologist running a technology business, you just want to know what the acronyms mean. You want to be able to sense check it, and that, and it's nice to be able to have people that you can ask those questions of. So that's what we act as. I'm going to pass you over in a second to Luke Morris. I mentioned the ISTM, which is the Ipswich and Suffolk Tech Network. We are a very well supported group. We've actually just pushed out for some sponsorship, and the response was overwhelming, actually. So we're just trying to catch up with all of that at the moment. Tyler and Ash actually work at a company called Strategic, who will be one of our sponsors. But we are growing all of the time. We have multiple meetups that sit underneath it. So if you visit, I will drop the details into the chat. We've got the istn.org.uk. We have various different meetups and run various different events all the way through to, we have a pub called the Thirsty Robot. And we've got female focus groups, lots of different things within it, all non-technical right the way through to technical. Cybersecurity is a big lean for us. Again, you guys were talking about fintech. This will be stuff that's of use to you in one way or another. So sorry, I'm waffling on now. I'm going to pass you on to Luke Morris, who is here to talk to you this evening about raising capital funding. He's here from Squat and Bland. I'll pass you over to him now. Drop any questions in. Luke, can I ask you to give people instructions as to how you want questions? Some people like them as they go, some people like them saved to the end, but just give us instructions and we will follow them to the letter. Over to Luke Morris.
Thank you very much, Sam, and thank you for that very generous introduction. It's a real pleasure and privilege to be here. I should have been here last month. That's why I just had to update the month on my slide there, but it's great to be here finally, and I do appreciate that. Questions, more than happy to take things as we go, as things occur to you. That's absolutely fine. You just might need to stop my flow or butt in. That's absolutely fine. No problem whatsoever with that. Just a little bit about me. The main thing I describe myself as is an accountant, a chartered accountant. I mainly get involved in transactional work, and a big part of what we do is about finance and raising money and trying to get businesses underway, various ventures underway, and so forth. So the subject matter this evening is focused on startup and early stage finance, how you raise startup capital. And I don't think, a spoiler alert, I don't think I'm going to give you an easy answer, but what I hope to be able to do is to stop you from wasting time and tell you where you're not going to get sort of fruit, and so that might give you some assistance. The problem you have as a startup or a new business, early stage venture, is that there's no track record. You don't have any assets. You perhaps only just have an idea. So what that means in accounting or finance terms is that there's no history of income, there's no demonstration of growth, and there's no security. So there's quite a bit of risk. So you chuck all of that into the mix. How on earth do you raise money? And I'm afraid I'm going to give you the answer straight away, because there was a study done about 20 years ago now in the US that looked at early stage businesses and where the capital came from. And basically 88% of it didn't come from the bank or from the government or from tax breaks or from the local authority. You can see this pie chart basically splits out the big three bits of that. 18% of that coming from the three F's: friends, fools, and family. Yourself, your friends, your family. 18% coming from there. 9% coming from profits and working capital. What do I mean by that? I basically mean not paying yourself out of what you've earned, putting it back into the business. I mean pushing your customers and pushing your suppliers as far as possible. But the biggest chunk, 61%, comes from informal private investors. So private individuals who are not regulated, they're not formal, they're not statutory in any way. they're just individuals. So that's kind of, I mean, a good rule of thumb is to follow the money. So I suppose the point I made a moment ago about where not to spend your time, it's probably a waste of time to talk to lots of banks and formal institutions and so forth at the very early stages. They will come and find you later on when they think you're more of a prospect. And that's often a problem that businesses have. They spend a lot of time talking to people that are not going to help them. So there's the answer straight away. I'll come back to that slide in a moment. What we're going to talk about this evening are the 6 ways, or really 2 ways, to get capital. I'm going to talk about sharks, dolphins, and fishes. I'm going to talk about the fallacy of the big idea. I'm going to talk about a wonderful sigmoid curve that appears everywhere in nature and business, which I call the business life cycle. I'm going to touch upon the primary financial statements, and I'm going to touch upon basic valuation concepts and tax concepts. I'll try and keep it to about 30 or 40 minutes and chip in as we go and maybe have some questions at the end. Let's see how we go. So what are the 6 ways to get capital? Well, there's a wonderful book by a magnate called Felix Dennis, a publishing magnate who some of you might know is dead now, unfortunately, called How to Get Rich. And he talks about the 6 ways of obtaining capital being there on the slide. So, and then he says, well, actually, the first 4 are probably beyond the scope of the book. And I think they're probably beyond the scope of this presentation too. But it is interesting. If you look at, I'm quite interested in history. And if you look at where we are historically, and you look back historically in terms of how capitalism has evolved and how wealth has evolved, certainly the Norman conquest has a lot to do with number 1. You might argue that what happened in 2008 around the credit crunch had a lot to do with number 2. And so, but we can strike through all of those. So we're left with, well, we can either earn the capital or we can borrow it. Well, earning money is a bit of a long-term plan, isn't it? I mean, it's okay if you start early on, but it's a lot of hard work and it's a bit of a long-term plan to earn money. But you do get lots of people who maybe are a bit reluctant to take the jump from employment into setting up by themselves, and they think, well, I'll just earn a little bit more, just get a little bit security, a little bit further on in my professional life, and then before you know it, they're in their 50s and they're ready to retire. So I'm not going to talk about earning it because I don't think that's what this dynamic group wants to hear. What I'm going to talk about is borrowing the money, and I'm going to explore the formal ways of borrowing money, namely debt or equity. But I'm going to also talk about what I think of how you can borrow money in terms of sharks, dolphins, and fishes. And the first thing I'm going to do is put a line straight through sharks, because what I'm talking about there are money sharks, lending sharks. I'm talking about sometimes you meet people who've maxed out their credit card or have taken a lot of Wonga type finance to get their business underway. That is always a no-no in my mind. And the reason is quite simple. It's not just the eye-watering rates of interest. There is a fundamental accounting mismatch there. Because what you are looking to do is to set up and establish a business for the long term, at least 5-10 years, grow something for the long term. So if you're setting out to be in business for that period of time or that sort of period of time, then there is a kind of rational disparity with borrowing the money to do that based on 30 days and paying at the end of the month. So we can cross a line through the sharks straight away. It's too short term, it's too expensive, and it's too risky. So what about dolphins? What do I mean by that? The reason I thought of dolphins is because dolphins flip things. What I'm thinking of there is you may have heard of venture capitalists and private equity type people. They're really smart people, but they are in the business of making investments for maybe a 3 or 5 year term. And what they are interested in doing is flipping that investment. And they're going to hold you to account, and they're going to wear smart suits, and they're going to be really smart about it. Now, the fact is, until we get a bit further along our business life cycle, those sorts of people are not going to be interested in us anyway. But I put them in there for completeness, and I'll talk about them in a bit more detail later on. Where we want to be is swimming with the fishes, and what I'm talking about by referring to fishes is those people who are going to be around there for the long term. In business, we call it patient capital. But what I want to make, the point I want to make is we shouldn't think of that borrowing from the fishes just in terms of cash. And I'll talk about what I mean about that in a moment. First, a quick aside, what I mean by borrowing and what I mean about debt and equity. So there are two broad categories of obtaining capital. The first you can think of as a loan. A loan from the bank is a debt instrument. What I mean by that is that it exhibits all of the properties of being contractual. You know, it will have a rate of interest, it will have a term, it will be legally enforceable, it will often have security attached to it. And because of all of that stuff, because of all of that certainty, it makes it a lower risk proposition for the investor. But because of all of that certainty, it often means that if you're early doors in your business, you don't have the security, you don't have the track record and so forth, then it's pretty hard to get debt finance. So the other type of capital is equity. And what we mean by equity is, I use the word residual. It's kind of what's left over. So if you think about your business or your enterprise, by the time you've paid back all of your suppliers and you've collected all the money from your customers, what is it that's left over that belongs to the shareholders or the equity holders? Well, that's what I mean by equity capital. So by definition, that doesn't have a contractual repayment term attached to it. That is something that only ever crystallizes in the future when you sell or possibly liquidate the business at some point in the future. So I'll refer to those terms later on. Now, I want to just talk about an idea that's always stayed with me, and I'd be interested in your experiences on this as well, which is, when you think about it, businesses in general are pretty much the same. They all have sales departments, they all have people dealing with marketing and finance and numbers and accounting and HR and all of those sorts of things. And, in a small business, it might be the same person that's doing all of that stuff. What is it that makes some of those businesses successful and others unsuccessful? I thought quite long and hard about this, and actually that grift, that ability to obtain initial capital is a really good marker of what's going to be a successful business, what's not going to be a successful business. It always comes down to the individual. And when you talk to entrepreneurs, they all have the same thing. The very worst bit of their job and the worst bit of starting up an enterprise is obtaining money. Back to my slide up here, look, we're talking about 60% of this money. This is a matter of fact, is coming from private individuals. So we need, as entrepreneurs, to toady up to those individuals and get money from them. And that can be humiliating. You've got to trudge around. You've got to have the door slammed in your face a lot. There are no real shortcuts to doing that, and there's no way of avoiding it. But I suppose you can take heart from the fact that's why not many people bother with it. And that's why the vast majority of people who are in businesses up and down the country are employees, and they are not entrepreneurs. They are not business owners, because, this is too much like hard work for them. So you can, there are some positives you can take away from that. Going back to Felix, he talks about obtaining that sort of 61%, how you go about it in the early days. He talks about pushing his suppliers, pushing his customers. He talks about working to get freebies from his business contacts, getting his marketing done free of charge, making promises later down the line, showing real sort of chutzpah and spunk and an ability to get something for nothing. And when he's talking about the actual obtaining of money, which is sometimes required if you need to buy a piece of equipment or invest in a product development or something like that. And the best way of doing it is to appeal to one of the two main human emotions, which are greed and fear. So if you are able to charmingly appeal to people's greed, then that's how you are successful. So going back to where we were and exploring the idea of what I mean by this and what I mean by fishes. Okay, so what we want to try and achieve is a situation where, as much as possible in the early days of a business, we might be getting support in kind. And that's why networks and groups like this one are really, really important. Using charm, using your abilities to get things done for nothing. That is a really important part of startup capital. The other reason I mention that is because wherever possible in the very, very early days, because success is driven by the individual, you want to retain control. I remember a long, long time ago, I worked with a colleague who really left a message with me around selling shares and issuing shares in the early stages of a business. And he referred to shares as a piece of real property, which of course they are. In principle, they are no different to an asset that you own, the phone in your pocket or the car on your drive. They are no different. Once you have issued them, once you've given them away, they are very, very difficult to recover, very, very difficult to get back. So almost as a last resort, you don't want to be giving shares away in the very, very early stages of a business. And the other reason I say that is I made the point earlier about the difference between those successful startup businesses and the unsuccessful startup businesses. Well, the successful ones always have a really driven, passionate individual, somebody who will not take no for an answer, and someone who, frankly, is a bit of an obsessive control freak. As soon as you start to get other parties involved at the very early stages of a business, you confuse the situation. You start to sort of introduce assumptions into the early decisions of the life of the business. And when assumptions are brought in, what does my other shareholder think about this? That is a recipe for cock-up. As I say there, assumptions are the mother of all cock-ups. If we have no assumptions, then we have no errors. So I talk about, in the early days, what we want to try and do is swim as far and fast up the financing curve as we can. I'm going to talk about angels in a minute, because I'm going to talk here about what I'm talking about with the financing curve. So this is probably familiar to many people. What you can see here is the sort of the typical curve, time on the x-axis and money on the y-axis. Whenever you have a new venture or a new business, you've got that initial point at the beginning where you are required, pre-revenue, you're establishing your idea, you're having to invest in things. It might be raw materials, or it might be sort of your IT setup costs, or it might be product development, or whatever it be. But it's going to come before the revenue. That then hopefully inflects and moves upwards, and up until that point, nobody really is going to be that interested in you, to be brutal, because you're pre-revenue, you probably haven't got a track record, nobody's heard of you. The only people that are going to be interested in you are the fishes swimming around you, and they're the people that are going to support you. And you need to be looking for their support, not just in terms of actual capital money, lending in terms of debt wherever possible, because you don't want to give the shares away, but also in terms of what can they do for you in kind. Can your supplier give you something up front? Can your customer wait a few extra days to be paid? Can you reach out to an ex-employer who might give you some support or some steer or some free space or something like that? All those sorts of things. We'll get further up that curve, and this is the point in time where I'm talking about the dolphins. And that is when they are going to be interested. They're going to want to be interested when they can see, actually, hang on a minute, this thing really is growing. We can see that there's real potential here. That's when the banks, the private equity, the venture capitalists, that's when they're going to start to show an interest in the business. Why? Because they want to lend money and they want to get a return. So they want to see that you're able to prove you can pay back what they lend you, and they want to be able to see that there's some security or at least some comfort that you'll be able to do that. This is quite an interesting chart. What this does for the early stage business, at every point on this kind of flow diagram, you get pointed into, quote, non-traditional financing sources. So you can see down in the middle of the chart on the left there, the business is higher risk with uncertain return. Well, that's where you're going to be at the beginning. You're not going to be getting traditional financing sources. Similarly, at the top of the chart there, if you're running at a deficit, you're not wanting to borrow the money for some specific purpose, then you're not going to be going through a traditional financing sources. So I'd say don't waste your time on traditional sources at the very beginning. I said I'd come back to the idea of angels. Business angels, really important part of this financing cycle, because they kind of bridge the gap there. They bridge the gap between that initial non-traditional source and a traditional source. That's where they come in. So if I flip back to where I was a moment ago, you can see here that I was basically saying that we're involved with an angel network here in East Anglia called Anglia Capital. So you can imagine it a bit like Dragon's Den, right? So you've got investee companies and entrepreneurs who are pitching their ideas to high net worth individuals. And there's a lovely quote there, only those with the intestinal fortitude ever receives the money from the investor. And I can say that absolutely true. And what the angels there's always two questions that they always have, or 2 points, 2 remarks that they always make on every single presentation that I have ever seen. And those two things are, first, we think your valuation is ridiculously sky high. Where did you get that number from? And second, is your business EIS or seed EIS compliant? So they are the two things to be ready for before we get to that angel part of the financing cycle. So let me talk about that quickly now. So we've exhausted all of that initial capital from our friends and family. We've pushed our suppliers and contacts as much as we can, and we do need to get some more money in to tip into that inflection point and to start to grow the business. A useful part is a business angel, and this is where we will start to need to give some of our equity away. Now, the good thing about business angels is that you can think of those as super fishes, right? So they are highly sophisticated individuals. They're often people who've made a lot of money. They're entrepreneurs themselves. And that means that they understand at that stage of your business life, you are not going to be in a position where you want to give all of your business away. And also they understand you're going to need not just monetary support, but support in terms of experience and moral support and everything else. So they're a really important part of this financing cycle. And there are angel networks around. And I would encourage you, if you haven't had somebody speak to you about Anglia Capital Group, then that's worth exploring. And indeed, they're all across the country as well. Okay, so what I want to talk about now briefly are some concepts that often confuse people who are maybe thinking of taking their business to the next stage of this cycle. They've exhausted that first tranche of fishes and they're thinking about talking to external informal investors, this 61% of my pie chart. What sort of things do they need to be thinking about? What sort of things do they need to be understanding? Now, hopefully I'm not teaching you how to suck eggs with some of this stuff, but I think it is quite useful just to recap very briefly over what these external people are going to be looking at, what they are going to be interested in. So I'm going to talk briefly about the primary financial statements. These are really important. I'm going to talk about what they mean, because often it confuses people. So you will have in your books and records what I would call a balance sheet, a profit and loss account, and a cash flow statement. We often have different names for them these days, but I'm going to stick to the old-fashioned names because it kind of makes sense to me. What do I mean by a balance sheet? That is a snapshot of the position of the business at a given point in time. So that is telling me in historic cost terms, how much money I have actually spent and how much I owe. That is kind of accrued in pound terms to give me at the current time, the 3rd of November 2021, is telling me what my assets are, what my liabilities are, and the difference is what belongs to me in equity terms. Now that's why it balances. So that's why it's called the balance sheet. Profit and loss account, that's a different concept. That's telling me about the performance of the business for a period to date. So here I'm actually wanting to understand, how has the business performed in terms of income, expenses, revenue, and cost. And this is keeping a record of that performance for the period to date. So far, so good. That sounds fairly straightforward. The most interesting primary statement to me and most early stage company investors is neither of those two things. Instead, it is the third one, which is, hang on a minute, how much cash is this thing actually generating, and how much cash is it capable of generating? Now, if you pick up a cash flow statement in a kind of typical format, it will split those cash inflows and cash outflows into three different categories: operating, investing, and financing. It's the operating activities that I am interested in. It is the operating cash inflows and cash outflows from selling my goods and services or exploiting my idea or technology that an investor is interested in. Why is that? Well, that stream of cash is fundamentally what is going to drive the returns to me as an investor. So that is what I am interested in as an investor. So very often when I pick up a set of accounts or some financial information for an early stage business, I'm interested in looking not just at what operating cash flow the business has generated, but what operating cash flows the business is capable of generating in the future, because that is going to underpin my valuation. And that's going to be the first thing that a third-party investor like a business angel is going to look at. Very often when we're talking to particularly early stage investors, and a client that we've been doing some work with recently, they have an idea in their mind of their passion and what it's worth in their mind. And I have to bring them a little bit down to earth, play devil's advocate and say, look, you do realize that there is a difference between price and value. And you'll be familiar with this concept. If you go to an auction and you pick up the catalogue, very rarely is the situation when the price at which the hammer falls is precisely the same as the valuation guide in the catalogue. And the reason for that is simply because valuation is a hypothetical exercise. Valuation is assuming a transaction. It's a transaction that hasn't necessarily happened yet. What is my business worth? I haven't sold it yet. What is my business worth? So, in practice, in professional practice, and also if I'm an investor looking at the business, a cold-hearted investor, the things that I'm going to be interested in, three things: cash flows, growth, and risk. They are the only things that I'm going to be interested in if I'm the business angel in that Dragon's Den scenario. That's what I'm thinking about. That is what's driving my decision. Those three things, nothing else. Now, of course, if you are the entrepreneur on the other side of that table, then you're thinking of an infinite number of things, because you are thinking of this emotionally. It's something that you've put your blood, sweat, toil, and tears in, and you will have an idea in price terms, which may have no bearing whatsoever to those fundamental value drivers. So I always say to clients, you can have an idea of price, and that is absolutely your prerogative. This is your asset, it's your business that you've grown, and before you introduce an early stage investor to it, it's up to you. You don't have to sell if you don't want to, but do keep in mind that there's going to be a difference of perspective as to how each of you are going to come to the table. You're probably going to have a price in mind, and that individual, which will factor in all of these emotions and things in the future and opportunities and things like that. The investor is going to be quite hard-hearted and orthodox and rational and have those value drivers in mind and very little else. At this point, I just want to talk about some terminology stuff that you might hear thrown around when you're entering into this arena of trying to raise money. It's important to draw a distinction between two terms that are often thrown around of equity value and enterprise value. So remember, before I was talking about the balance sheet, and I was talking about assets less liability equals equity. Well, that gives me a measure of equity value, but the problem with that measure is it's a measure based on historic accounting records. It's not necessarily giving me a measure as far as the market is concerned. So the best way to think about equity value is probably from the back page of the Financial Times. So if you turn to the back page of the Financial Times, we have a very readily available list of company shares that are being traded actively every day, and there's a live price for each of those shares. So, the best way of thinking about a market equity value is to think about, okay, well, I can look at a share in Tesla, and I can see it has a certain price attached to it. So that is the equity value. That's the price of that share. We often use information like that, by the way, from a valuation standpoint, because the market is very helpful. It gives us a live price per share for businesses, and it also gives us an indication from their financials of their most recent earnings. So you might have come across this price to earnings ratio before, the PE ratio. That's a really useful device in trying to figure out how much something is worth. You might hear, company X is trading at a PE ratio of 10. What that means is that the market is paying £10 for every £1 of earnings. So, that's quite a useful valuation device. You can think of your business, right? This is very crude, but you can think of your business. Well, if I'm earning £1 and I can see a business listed on the stock market that's doing similar sort of stuff to me, and I can see that it's trading at a different number, but it's giving me a price to earnings ratio of 10, then I can see, if I'm earning £1, each of those pounds is worth £10 if I was to sell my business. So, if I'm earning 1,000, then the business is worth 10,000. It's kind of rough and ready way of looking at valuations. That's how you work out a share valuation based on market data, crudely. Enterprise value is a different concept. And what this does is, instead of looking at a price earnings type approach, it kind of looks at a measure called EBITDA, which we talk about a lot as accountants: earnings before interest, tax, depreciation, and amortization. And the reason we talk about what is essentially an operating profit number before depreciation is that this gives us a really quick and dirty, rough and ready approximation of that number I mentioned earlier, operating cash flows. And that's a measure that investors are interested in because it's telling me how capable the underlying business is of servicing the investment that I'm going to make. How quickly will it be able to pay back the investment that I'm about to put in? So we, in practice, we use EBITDA as a measure quite a lot. And we can look at different companies that have recently sold. What was the price that was paid for them? And what was their EBITDA? What was their earnings? So in a similar way to the price earnings ratio, that gives us a so-called multiple of earnings. Why that's useful is that that's a quick and easy measure for us, again, to apply to our own earnings to figure out what I'm going to call the enterprise value. Why is it the enterprise value in this case and not the equity value? Well, EBITDA is a measure before interest, and interest is what you pay on debt. So what that means is enterprise value is a return to both equity holders and debt holders. Remember my earlier slide where I was talking about the two different types of borrowings. The easiest way to think about this when somebody's talking about enterprise value is to imagine two companies. Imagine two companies that are exactly the same. They're identical, except for one important fact. And that one important fact is that company A has borrowing of £10 million and company B has borrowing of 0. Well, if both of those businesses are earning at the same level of profits, then my enterprise value for each of them is going to be exactly the same, because I'm going to apply a multiple the same to each of their earnings. I'm going to get the same enterprise value. But the equity value will be different, because in that case, company A would be worth £10 million less because of its capital structure, which is different. I have to take into account the fact that company A is more indebted than company B. That is why enterprise values is a useful thing for us in practice, because, and as investors as well, because it allows us to quick and easily compare companies and businesses that have different capital structures. It sort of takes into account that. Probably best illustrated in this chart here. And the reason I'm telling you all of this is because these are terms that are thrown around quite a lot by investors. So it's important that you have a little bit of conversance with them, what they're trying to get to. So you can see this what this chart essentially does is say, okay, these different terms, this is how they compare to each other. So over on the right there, we have what our balance sheet is showing at any one time, the book value of the assets. Hopefully they are net assets. We have more assets than liabilities. So that's the bit that's coloured in grey. But remember, that's computed on a historic basis, and the market may have decided that we have certain intangible assets, technologies or assembled workforces or sort of data practices or things like that, that's worth more than what it's cost us to get to that point in time. So that's where the enterprise value bit comes from. And then trying to take into account the capital structure is the difference between enterprise value and equity value. So that's what that chart is essentially doing. So some final comments, because I think I'm probably at my time and I'd like to have some questions, and I've not even looked up, so I don't know if there've been any questions while I've been prattling on. Just want to talk quickly about tax and what's really important, some important points to make, particularly for early stage capital investors. Tax, you shouldn't worry about tax too much because tax only becomes a problem, and a problem that we can do things with when you're actually making some profits. And remember this chart I've got here, we're at least going to have an early stage, at that launch and initial growth stage, when, there's not going to be a great deal of profit around. So there's not going to be a great deal of tax to pay. The interesting thing to say about the difference between equity and debt is that when we are borrowing money in terms of debt, you're going to have to pay interest. And that is deductible for tax. So that is something you need to take into account when comparing the cost of capital of debt versus equity. Something you'll have heard about with capital gains tax, I'm sure, is what we used to call entrepreneurs relief. It's now called business asset disposal relief. And this is only in point when we are actually selling our shareholding and making that capital disposal of our business interest. Essentially what that says is that we pay a 10% rate of tax on that gain up to a cap of £1 million now. That's something just to have in your mind. And it kind of speaks to what I said earlier about how equity is a residual thing. It's only realized when there is a capital event, an exit or a sale at some point in the future. And then just a final comment. It's worth looking into this a little bit more, particularly if you are thinking of pitching to any angel groups. I mentioned earlier the two questions they ask. We think we want to challenge your valuation is the first question. Second question, are you SEED EIS or EIS compliant? What that is a very tax efficient wrapper for the investor. So essentially they get quite a significant kickback on the tax cost of their investment. In short, if it's a CDIS investment, they can get up to 50% of their investment back. So business angels are always very interested in that. Certainly the most recent events that I've been to, that is something that's seen as, well, if you haven't got that, then we're not really interested in making the investment. It's a fairly straightforward process to go through, but there are one or two forms to fill in. It's just something to have in mind, and just something to make a note of. Maybe it's a subject of a future discussion if there's enough interest for it. So I think that is a fairly quick canter through things that have occurred to me over the years when it comes to startup capital. I'd be delighted to have a discussion or take any questions or talk more about any of the slides or any of the issues that are that have been raised there today. So I hand back to you now, Sam.
You can hand back to me, but guys, it really is open to the floor if anyone's got any questions. And thank you. That talk was incredible. I heard that talk about 5 years into running a startup, and that was probably too late. So if you're early doors, not this specific talk, but a lot of the advice around it, and I think it's invaluable. Absolutely. This to my mind is stuff we should be teaching at school. Like, you know,
I think for me, Sam, it's just the most significant wasting asset is time, and that's so crucial in the early days of a business. You might be trying to get first movers advantage. I mean, particularly if some of people that you speak to are doing technology type products. That's so important, and it makes me so sad sometimes to see people wasting time exploring blind avenues, and which is demonstrated on that pie chart. There it is. It's not me making that up.
It's endemic in as far as what I'm watching is essentially two time frames colliding. We've got old infrastructure, which would have been an old startup model with less technology, being replaced with new structure, and we've not caught up. So we're in that kind of limbo where long-term this will be out of the gate what they do. But at the moment, the advice, the elders in the system, you're a progressive, you've been involved in technology, scrap and brand ahead on this. Not all financiers are the same. So I think it's about finding the right people at the right time who are ahead of the curve, and that's a difficult thing to find, and I think it gets easier every year, obviously. Guys, has anyone got any questions? Feel free to put your hand up or just pitch in, put your camera on or not. Paul, it's not like you to be quiet.
Yes, I do have a question.
Yeah, cool.
Who's first?
You go first.
Is it Tyler? Okay. I think you showed a website when you spoke about angel investors.
Yeah.
Is that a website where you can pitch them or get in touch with them or anything?
Yes. So I can't remember there it is. Okay. I think business angels 10 years ago, 20 years ago had a bit of a bad rap. Everybody thinks of Dragon's Den and aggressive people in suits and that sort of thing. Back in 2010, there was a piece of legislation around seed enterprise investment scheme and enterprise investment scheme. And the idea with that was to try and widen out the private share ownership in the country. And it got off to a slow start, and really only over the last, 5 or 6 years, maybe a bit longer than that, is it really been sort of picked up by people who are high net worth individuals who have their portfolio of shares and whatever else, and maybe have had a successful career in business, who are now very, very incentivized to put capital into higher risk, and it has to be high risk, capital at risk enterprises. And so what's happened is that there's been a real growth across the country of fairly informal groups of angel investors. So Anglia Capital Group is the one that's close to my heart, because I was quite involved when it first came to Suffolk a few years ago, and there were 0 investors and 0 investee companies. Now there are approximately 50 business angels, high net worth individuals who are members of that group here in Suffolk. They cover a whole range of different sectors and industries: transport, logistics, education, food, drink, technology, the whole gamut of business they've got experience in. And we've got a very active group now. Actually, it's translated really well to a Zoom kind of environment. I didn't think it would, but it has, where every 2 or 3 months, half a dozen investee entrepreneurs will come along with a 10-minute pitch and have the opportunity to pitch their idea to these individuals. So these are people who've exhausted those friends and family and their personal funds. The business is starting to take off, and they just need that next level of hundreds of thousands as opposed to tens of thousands of investment. The group works really well because it's like a syndicate, right? So we had one the other week, which was a food processing business. They wanted 150 grand. That's a lot of money for any individual, even if it's a very tax efficient investment for them. But if there's 10 people sticking in 15 grand each, and it's costing them a net 7.5, then that's something that we can get away. And then that's kind of where these groups have been really good. So I'd encourage you to look at that. And it's not, there's a whole network of them across the UK. It's not just the one here in the East. But it's something that people are still not always aware of. That's why I mention it.
All right, thank you for your answer.
Good. Next question, Tyler. Did you have a question?
Yeah, I did. So I guess my really good presentation. Thanks for your time, Luke. As we kind of start our phase next year of getting out to potential investors, obviously really interested to hear a bit more about their groups. Thanks for explaining that. But often it's going to be out networking, just those introductions through people, or just old-fashioned getting on the pavement and going out and trying to meet people. Outside of our sales pitch or elevator pitch, whatever you want to call it, is there any, not so buzzwords, but anything that we should be including in the elevator pitch that just instantly will recognise as investors that we are serious? It's not just a pipe dream. I don't know if that's a clear question or not.
No, it is. I mean, I've sat through lots of these pitches, and I've seen the ones that are successful and the ones that aren't successful. The thing I would point you to really is at an early stage. It's this. Where is it? Where's my ladder slide? It's this slide that's the most important. So the investors they're always backing the individual, Tyler. So, I think the ones that tend to succeed are the ones where the sort of the determination and the doggedness and the obsessiveness of the individual comes through in the presentation. And almost the idea, almost takes second stage. It's almost secondary. I was meaning to talk. I didn't really have time, but one of the slides I had in here was around the idea fallacy, and I don't know if that's a concept you've come across. The investors there who are sat with their valuation fundamentals are not always that interested in the idea per se, in the way that the entrepreneur always is. What they are interested in is the execution. It's all in the execution, and they're trying to fathom and gather, is this individual, because it will be this individual that's driving it, are they up? Do they have the stomach? Can they execute this idea? The idea has to be good, but it's the execution that's decisive for the investment always, and that's what they're trying to weigh up the individual. I don't know if that really answers your question. I think all I would say is the people who are successful are not afraid to be themselves. They don't try and be contrived, and they are just themselves. And I think that is really important because the angel is backing the individual more than the idea and more than the business, because it's the individual who will execute the idea.
I don't know if you'd agree with this, is that I think the other side of that then is I totally agree, it's always about the person and they're less interested in the idea. But actually, the more data you can bring to the table, so that if you follow that sort of lean methodology of like market testing analysis of what the growth would look like, that numbers, you can't, numbers and the research, the fact that you've done that research. I think sometimes I listen to, I've been going to the Angel, I've sent you the details actually by email, to the Angel Network at University of Essex, and it's teaching people to be investors. It's really interesting. Yeah. John Stenhouse's running it. But there's an element of kind of solidity, that it's easy to kind of, people lean into the idea and it becomes a bit fanciful. It's kind of like it's a magical thing and it will be a magic because I believe in it, when actually what you really need to know is that it's going to grow. It's a solid thing that I'm going to grow and it's going to gain traction. Yeah. So I think data is backing it up with data and real hard facts. Anything that you've already discovered always seems like a good move.
Yeah, I think I would agree with that, because I think what that does, it speaks to the fact that the entrepreneur is serious about execution, doesn't it? Basically, they've done their homework and they're all over it. That's kind of what the data does. I think it supports that. So yeah, I think we're saying the same thing, to be honest, Sam. I would agree with that.
Anyone else got any questions?
I don't have any questions for now, but I just wanted to say thank you very much, Sam and Luke, for creating this event. It was incredible. Thank you.
Thank you very much. Yeah,
Pleasure.
We'll pop the details and we have lots of other talks coming and we're going to focus on this type of event. Actually, there's lots of other things coming forward. I'm looking out for your message, Paul. If there aren't any other questions, do connect with Luke on LinkedIn. You know, I know you give many talks, Luke, so I know you're not doing Ipswich and Suffolk Business Club, but I know you well enough to know there'll be you'll have other fingers in other pies with things that you're attending. So stay in touch, connect with Luke. If there's anything else we can offer, actually, let me just pop my the details about the ISTN in the chat, so you can find details about our other events at istn.org.uk. We're more than happy to listen. If you guys want any other talks, if there's something else you want us to arrange a talk on, just give us the title. We'll go and find you the best speakers we possibly can. And alternatively, one of the things we're very keen to do is context is always very difficult for a startup. So I met with Tech Nation recently. If you are a startup, again, go and sign up to what Tech Nation offers. I find their resources very useful. It's just a cohort. And sometimes what it's useful to have is that peer-to-peer support. If you're a non-technologist building a technology business, you want to be able to sense check what the acronyms mean and things like that. But Tech Nation came and visited me and said, why do we not get enough traction in rural environments for tech startups? So they've just run a scale up 4.0 model that looked quite interesting. And my answer to that was that I don't think people in rural environments understand what the terminology means. I think they are startups, but they're not in Shoreditch being a tech startup. They are, but they potentially could be applicable for funding. So get tenacious. There are little pots of money out there and there's definitely extra support around that. So we'll try and do more and foster more of that, get Tech Nation to come and do a talk, etc. And if anyone else got anything else to add? Anyone else want to give any advice to startups? I noticed that David taking his mute off.
Tomorrow night, I will be in the Wolsey upstairs for the Ipswich Tech Drinkabout, first Thursday a month. So we are back in a pub, and I will be indoors as well because it's cold and miserable outside. So
fantastic. Hopefully the dog will be there because it's really the dog we're all there for.
No, the dog doesn't come inside the Wolsey. They're not compatible. So.
So we've got Ipswich Tech Drinkabout in person in the Thomas Wolsey in Ipswich tomorrow, and then every other Thursday we have the Thirsty Robot. The link should be on the ISTN website. It's been an absolute pleasure to have you, Luke. Thank you so much. Fantastic as usual. We've recorded the event. Go on.
I was just going to add one other thing that as I've been through a startup recently, I'm happy to have a chat with people about the pain and the pleasure of doing it. I suppose technically I'm in 2 at the moment, possibly 3. So
you know what you could do is you could give a talk, couldn't you?
I has been crossing my mind that I might have to actually admit to it at some point and do that.
I'm going to drop you the link, so get that signed up.
Yes. Okay.
Again, come back to if there's anything else we can help with. Thank you so much for attending. There is a recording of this event. We will send it back to you hopefully within the next sort of few days or so. Get the recording back, and if there's anything else we can do to help, let us know. Thank you all very much.
Thank you. Bye.
Thank you very much.
Thanks, guys. Bye, bye, bye.